Good morning, David. Happy Monday, everybody. Sort of a mixed open, a little bit 3-2 declining to advancing stocks. We had some help. Take a look at sectors from tech early on. So NVIDIA, Qualcomm was up, Microsoft was up. Banks are flattish. Materials generally having a tougher time. And energy, oil was near $56 about 2 hours ago, and it just sort of dropped down dramatically. We were at a 2.5-month high, so energy stocks are lagging right now. The good news is the market internals are terrific. We've just had a fantastic 4 weeks or so here. The breadth on the New York Stock Exchange is not quite the old historic highs in September, but it's not far from there. Buying power, how much buying pressure there is in the market, these are terms Lowry uses, has been increasing. The selling pressure, the amount of shares coming in to sell every day, has been decreasing in January. And volatility, VIX is at 16 and change. That's near a 4-month low. Here's the bad news. The market is kind of pricey right now and expensive. How expensive? Well, it depends on whether you think we're going to get 0% earnings growth in 2019 or 4 or 5%. That's kind of the dividing line that's been hitting us. So first quarter earnings, put up first quarter earnings here, up 8.1% on October 1st. Today they're down to 0.5%. So the debate is, do we get negative earnings growth for the next couple of quarters? So far that's not happening, but the numbers have been coming down here. Schumer's and Sanders, David and Jimmy mentioned the editorial they had on buybacks. That generated a lot of discussion over the weekend. And I think the important thing that's out here, put up that corporation, where did the profits go? Their claim is very interesting, and I'm trying to verify all these numbers. They cherry-picked some numbers here. 2008 to 2017, they claim 53% of the profits went to buybacks, 30% to dividends, and implying capital expenditures or a few other things was only 17%. That's a very high number, and I'm trying to verify all of that, but it certainly makes it difficult to argue for the buyback scheme. The other thing that they did not mention, I was surprised at, is the buybacks have, with the exception of a few companies, not dramatically reduced the amount of shares outstanding. And the reason that has happened is because the companies keep adding options on the front end to that. So put up that shares outstanding here. We've had about 300 billion shares outstanding in the S&P 500 for years now. And you can see it hasn't changed all of that much. Some companies like IBM and Exxon and Apple have dramatically increased their shares outstanding. They're buyback monsters, I call them. But for the vast majority of the S&P, the shares are relatively the same because of the options that keep being added. Again, this makes it a little bit difficult for the companies to argue that there is all sorts of benefits from reducing from the buybacks themselves. Finally, the IPO market is opening up again this week significantly. This is going to be the big year. There was a legendary year in 1999 and 2000 where we raised almost $100 billion. That was the dot-com movement. They have been trying to get over that for 20 years. The question is whether they can do it this year with over 200 companies, including Uber and Lyft, Palantir potentially, sitting out there. We'll talk that a little bit more in the 11 o'clock hour. This could be the big year, David, for IPOs, but a lot's got to go right to have that actually happen.